So, chapter 7. Did I say chapter 13 earlier? Okay. We're studying information systems in my intro to business class, and it's chapter 13 there. So, I thought maybe I mixed it up. For us, it's chapter 7, and it's accounting information systems. Okay. So this is what we will learn about in this chapter. What are the components of an accounting information system? You might remember I talked a little bit about systems on the first day of class. And I talked about how corporations are systems that turn their inputs into outputs, just like human beings, and any biological creature is also a system that turns an input into an output. Well, we'll learn about accounting systems and how they take inputs and turn them into outputs. We will also learn about special journals and subsidiary ledgers. So you know what a journal is, and you know what the ledger is, but so far we've been talking about the general journal and the general ledger. Now we're going to get into some variations, special journals and subsidiary ledgers. And that relates to accounting information systems because that's part of how we organize the information. To be honest with you, everything we do in this class has to do with accounting information systems, not always from the computer standpoint, but that's what accounting is. It's an entire system to keep track of companies' finances, right? To keep track of the inputs and the outputs. So we'll also learn the special journal relationship to different stakeholder groups. Why do we need to have these special journals? What's the benefit? We'll learn how to do the journal transactions. We will talk about career paths related to both accounting and information systems, because if you've got skills in both areas, would you put your name on the list? Make sure you do that. If you are trained as an accountant and trained in information systems, that's a very powerful combination, and that opens up new career opportunities to make even more money and be even more, provide even more value to certain organizations. So we'll get into careers a little bit later. All right. So let's see. An accounting information system, you can abbreviate as an AIS. Okay. And what does it do? Well, if you just think about the accounting cycle, it all starts with the transactions, right? Step 1, you have to identify and analyze transactions. Those are the data that make up the inputs into the accounting information system. So you have to collect the data, record it into your journal, into your ledger, right? Those are steps 2 and 3. The data have to be organized. You summarize them in financial statements to say, hey, this is our total assets. This is our total liabilities. This is our revenue. This is our expenses, right? And we use accounting information to do that and make other reports as well. Now, most companies, computers are used in their accounting process. You could have a small company where you don't. Maybe you write everything down in a physical journal and a physical ledger, but that's pretty rare. Even small businesses today usually use QuickBooks or some other program to keep track of their accounting transactions. Okay, any questions or comments so far? All right, so systems. Again, systems turn inputs into outputs. They have subsystems within them. Every system is made up of basically smaller units. And the same thing is true in an accounting information system. So you need to have inputs to get the data into the system. The system has to be able to process the data. This is where software comes in handy that can add things up for us and do a lot of these calculations that you're having to do manually, right? But software can actually do that for you. like calculating the appropriate sales tax. Then software can also, or systems can also summarize the data, like we do, like let's say you needed to know your total sales. Well, the software can tell you that, right? And then present it by making statements and reports that you could print out, you could email, you could present. And systems have to also store the data, right? Because what if the data, let's say the hard drive crashes, and you lose all of your records, all of the history of the company's finances. Ooh, that's not good, right? So that's why you need to back up your storage devices, either to other hard drives, or these days, a lot of the backups go to the cloud. So it's stored on some server somewhere. So this is all, you know, elements of today's modern accounting system and how we use computers to do all this. Okay, questions, comments? All right. Oh, yeah. So let's go to the Wayback Machine, way back in time. This is Macy's. I'm sure you're familiar, even if you've never visited a Macy's, or maybe you have. My wife seems to go there every week. Yeah, she likes it. So it's a department store. They sell clothes, perfume, and all kinds of stuff, right? Well, this was from their very first day in business. Let's see if there's a year on here. I think 1858. That was a long time ago, right? Their first day in business, they made $11.06 in sales, which apparently today is worth more like 340 bucks. But for a store, that's not a lot of money, right? Even $340, not a lot of money. But hey, it was their first day, right? So give them a break. And we can see what they sold. Let's see. Oh, no, we can't. It says first day sales, cash on hand. I have no idea what that says, or that. So obviously, this was done by hand, right? They didn't have computers back in 1858. And so all the accounting had to be done manually. It's still a system, right? They could still go through all the steps in the accounting cycle. They just had to do it on paper instead of on a computer. I'm glad we don't have to do it that way anymore. Okay, oh, I broke it. How did that happen? It was working and it stopped working. Now, you still do see paper sometimes out there in the business world, even though companies have really made a lot of progress over the past few decades moving to paperless systems. Here's an example of an invoice, and we know from previous chapters an invoice is a source document, because an accounting department that receives an invoice has valuable information on that invoice that they might need to put into their accounting system, right? So that's what makes an invoice a source document. Well, here's an example. This could be a printed invoice, or it could just be electronic. And you see how it's formatted and some of the data on that invoice that might be useful to put into the accounting system. Let's take a look. So we see what company the invoice is from. We see that it's an invoice. We see who they are billing, which is our company, right? If you get an invoice for another company, not your responsibility to pay for it. So you would want to send it back and say, hey, this is not for us. What else? It says where payment should be made to. There's an invoice number, which is going to be unique. Every invoice would have a separate number. So you could, if you called up the company and said, I have a question about the invoice, you could tell them the invoice number and they can pull it up in their computer system. There's a date. You might recall that whether or not there's a discount for paying early is based on the invoice date, right? So we need to establish what that date is. There is a customer ID number. So if we receive this invoice from Symmetry Mold Design, who do you think issued that customer ID number? Did we come up with that, or did they come up with it? What do you think? Do we generate our own customer ID number, or did they assign it to us?
They did.
They did, yeah. It's their way of keeping track of us in their computer system. So if we call them up and they ask us for the customer ID number, we can get it here from the invoice. We see the terms. I'm going to come back. Oh, actually, let me make this bigger. Sorry, that's pretty small. So easier for you to see. Okay, now what's going on? Okay. All right, so that's what we've looked at so far, right? We see a due date on there. We see what it is that we're being invoiced for. Pretty detailed explanation of what we purchased. There's something else that's part of it. Some services that they're providing, I guess, to us. So then we get a total cost that they're invoicing us. We've paid 0 so far. And so the amount that we do is the total amount. I mean, the amount that we do, is that what I said? The amount that we owe. Okay, but let's take a closer look at the payment terms. We've seen payment terms like 210, net 30, and things like that. Notice, actually, should scroll back up. If we take a closer look at the payment terms that are here, they're telling us we get a 4% discount if we pay in 30 days, 2% if we pay in 60 days, and the net is due in 90. We haven't seen that before. They're giving us 2 different possible discounts depending on how soon we pay. And so here they've broken it out. If we hit the earliest deadline, we get the 4% discount. If we hit the second deadline, it's the 2%. And then if we miss them both, well, the total is still due by 90 days. Okay. So all of that information is on this one document. Any questions or comments? Watch, I probably broke it again here. Oh no, it worked. What do you know? Okay. So here is another type of document that could be useful for an accounting information system. Might be familiar with this retailer, Kohl's. And, you know, Kohl's is another department store. So let's say you had bought something at Kohl's and you charged it to your Kohl's account instead of paying at the time of purchase. You have some account with them. And they might send you a bill in the mail like this. And you would actually send this part of it back if you're mailing in a check. Okay? And I know a lot of people don't actually mail checks anymore, but some people do. So this document that you send back with your payment has your account number, the due date to help you know when you need to pay it by, how much you owe. But because you have an account with Kohl's, they're going to let you pay just the minimum amount instead of paying the full amount. Well, that's nice. Not really. Not really nice. Why would they let you pay only a smaller amount? Yeah, so they can charge you interest on the amount you didn't pay, right? And then if you're late paying the amount that's the minimum, not only are they going to charge you interest, guess what? They're going to add some fees on top of it, right? So that's part of how financing companies make money. Interest and fees. Okay, but you're going to pay it off, right? Because you want to manage your finances effectively and not have to pay interest. So you're going to pay off the full thing and you're going to mail it to this address. In fact, there's probably an envelope that you can stick this in that has a little window so that it automatically shows the address that it's going to. You don't have to write the address, you just stick it in there. And notice it's got some barcodes on here. So there's a barcode so that when Kohl's receives this payment, they can just feed it into a machine with the check and it processes it automatically. Based on this barcode, it knows which account you're paying for. And then based on whatever you write in this box, it knows how much you paid. And somehow they check to confirm that that's the same amount on the check. There's also your account number down here. So it's a very streamlined system to make it easier for customers to make their payment, and it makes it easier for the company receiving that payment to process it. In fact, in many cases, the address that it's being mailed to is not really a Kohl's location. Well, we see it's a P.O. box, but it might not even be a P.O. box that Kohl's checks. There might be another company that receives that mail and processes it for Kohl's. That happens very often. So it's a very automated, streamlined system that allows them to get their money. Of course, these days with people making payments electronically, that's even more streamlined, right? You don't have to worry about the mail system to pay electronically. Okay, any questions or comments? Oh, I saw a hand. I think it was my imagination. Okay, all right. So we kind of talked about the difference between manual and computerized accounting. Obviously, computers tend to be more accurate than human beings, right? So not only can they process things faster in many cases, they tend to have fewer errors. All right. So let's talk about outputs. Every system, as I said, has inputs and outputs, right? So that's true of an accounting information system. For example, if you print out a page from your computer system, that's an output, right? What's being displayed on the screen is an output, right? This is the screen, not the computer. The computer is over there, but it's sending that information out to the screen. So this is an output device. If you email somebody, again, you're sending that information out of your computer to theirs. So those are outputs. Many banks require electronic data, especially for companies. They might require that the payments be made electronically. They might even require the payments be made automatically. Sometimes the bank gives you a certain rate on the loan if they can automatically collect the payment from you instead of having to wait for you to send it in. Some government agencies require that you transmit information to them electronically. God bless you. More so with companies than with individuals. So if you have a business, you might find that for certain taxes that you need to file, you have to do it electronically. And of course, most companies do file their taxes electronically. Information such as financial statements and stock offerings, those have to be transmitted to the Securities and Exchange Commission. They require that that be done electronically as well. Later in the semester, in the last couple of weeks of the semester, there's going to be a course project that we're going to be working on, and we'll go over that in more detail sometime after next week. Because next week is week 8. I'll have a midterm next week. And then sometime after that, we'll start talking about the course project. When we get to the course project, though, you'll learn that you're going to have to do some research on some different companies. You're going to have to pick a company that's publicly traded. You're going to have to analyze their financial transactions, their financial statements. And one way to get those is through this program called EDGAR. That's provided by the SEC. You can see what EDGAR stands for, Electronic Data Gathering, Analysis, and Retrieval System. So it's easier just to say EDGAR. So EDGAR is a place where you can see any publicly traded corporation's financial statements. And it makes it somewhat easy. It's not the most user-friendly system, but fairly easy to actually find those financial statements and use them in your research. So we'll talk more about that in a couple weeks. Since I brought up the midterm, I hope I didn't cause any anxiety for anybody. Let's go ahead and just talk about our midterm. It'll be due by the end of next week, okay? You can do it in Canvas, so you can do it whenever you like between now and the end of next week. It is, all of the questions on the midterm will be questions you've seen on the chapter quizzes from chapters 1 through 8, okay? No new questions. It's all going to be multiple choice. You'll have 3 hours and there are only 50 questions, okay? So I know in some of your classes, your midterm might be stressful. This one, I think, shouldn't be too stressful. However, you only get one attempt. Do keep that in mind. That is a difference from the quizzes that once you start it, the clock is ticking, you've got 3 hours to complete it. Most people finish it within about an hour or less. Any questions on the midterm? Okay. So let's move on then. So we talked about outputs. Let's talk about storage. Obviously, you can store data in paper format. What are some problems associated with storing information on paper?
Get lost.
Could get lost. What else?
Erase.
Could get erased or what?
Takes a lot of space.
Take space. What else?
You get damaged.
Could get damaged, right? Could get eaten by rodents. could get burned. Could get water damaged. It does take up space. Offices used to have tons and tons of filing cabinets full of paper. If something is misplaced in the wrong file, good luck trying to find it. So there are issues with paper storage. Although a lot of those same things could apply to a computer. A computer could get damaged, right? Could fire damage, water damage, the hard drive can crash. One nice thing about storing data on a computer is you could maybe do a keyword search, makes it easier to find information. What are other benefits of using a computerized system to store your data? Safer? How so? It's a little harder, yeah, it's a little harder to damage it. But in addition, you can have it backed up, right? Can you imagine if you had a file cabinet with 1,000 files in there and you wanted to make a copy of everything that was in there? It would take you forever. A hard drive you could copy really easily within a day. Just say, okay, copy from here to there. Just copy. So you could back up your data to the cloud. You could back it up to another hard drive, either locally or stored off-site somewhere. So that's one of the benefits. In general, I would say computer-based storage systems are better for that reason, especially. Now, there is the danger of it being hacked. It's hard for someone to hack a filing cabinet unless they're actually in front of the filing cabinet. But you can hack a computer from anywhere in the world if you are a good enough hacker, right? So that's an issue too. How do you keep it secure? As it says here, you want to have adequate controls to prevent fraud or unauthorized access. Not only keeping hackers out, keeping employees who aren't supposed to be nosing around in those papers out, right? How do you do that? How do you keep them from accessing those computer files? Well, the way companies typically do it is they give people different permissions. Just like what you see in Canvas is a little different from what I see in Canvas, right? You could see your grades, but you can't see your peers' grades. And that's because of the permissions that have been set up in the system. All right, any comments or questions on storing data? All right, oh, here we go. Here's data storage. this is even older, 1764. So this is Barent Roseboom's ledger. I have no idea who that is. And he's keeping track of transactions with a John Fluno. No idea who that is either. But interesting. So on May 15th, at Fort something or other, apparently John Fluno bought a shirt and some chocolate and a pair of breeches. So this was all hand recorded, right, in John Fluno's account. So this is the ledger. This is John Fluno's account in the ledger. And over here, this would be the general journal where it's just a running list of every transaction that occurred. That one's a little bit harder to see. We've come a long way. All right. So let's see the different elements here of an accounting information system. You can take information from a source document like an invoice, input that into the system, and then the data are stored on the hard drive. You can use the system for processing and figuring out, for example, well, let's say you've made the payment on that invoice. You could then enter that data, and then the software is going to now mark that invoice as paid. Right? So the software is processing some of the data for you. And then you could print out, for example, what are the unpaid invoices? Then you have a document that showed you which invoices had been paid. So this system takes inputs, processes them, turns them into outputs, and you have storage at every stage along the way of what went in, what got processed, what is the result. Okay, makes sense? Let's see, what are some types of information the accounting information should be able to provide? Let's start with owners and managers. What type of information do they want out of the accounting information system? What do they need to know?
Gross sales.
Sales, exactly. What else? Just sales. That's all we care about, sales. Expenses, okay, right, because then we know our profit, right? Sales minus expenses is our profit. We might want to know what assets we have, what debts or liabilities we have, right? Now, how about the employees? What information might they be curious about from the accounting information system?
How many hours they've worked.
Okay. How many hours they've worked, because that impacts how much they get paid, right? They might want to see what deductions came out of their paycheck. Maya?
So, like, I used to work at, before we used to get paid commission for like a certain amount of things, and the accountant has to
Figure that out.
refer to that too as well.
Right. So there might be a separate system for keeping track of what you sold, but that information has to be available to the accountant so they could figure out what commissions you earned, right? So those might be two separate software programs, but definitely the accountant would need that to know what to pay. All right, and let's see. And then other external users, we could think about banks. If the company applies for a loan, the bank's going to want the financial statements. If the company wants to make a purchase from a supplier, the supplier might want to see a purchase order, which is a document authorizing the company to make that purchase, so that it knows it's a legitimate order and not just some employee trying to scam something, because that could happen in some cases. So as you see, the accounting information system provides a lot of information to a lot of different parties. Oh, this is just explaining, we might have talked about this before, how accounting is like baking cookies or something. You have to take the ingredients, process it, turn it into an output, right? Which is a system. You go in your kitchen, you take a bunch of ingredients, those are the input, you mix it, that's the processing, you bake it, now you've got product, an output. So accounting does the same thing. Let's think about, again, source documents. Those are, again, documents that companies would use to receive information that they don't already have. So that information can then be put into the accounting system. If you are a grocery store, you order some produce from a supplier. They will provide you the produce and an invoice, right? And we saw what an invoice looks like. Let's think about the steps here that are involved. Input, the storage and processing, and then the output with a grocery store. Obviously, the produce is an input, right? One of the things the grocery store needs to take in order to run their business. What do they do when they receive that produce? They just take the whole box and put it out there for customers? What do? They make it look nice and pretty. They're adding value, right? They'll make sure it meets the quality expectations. They might wash it again. They might place it out. They might take it out of the box and place it nicely. And then consumers come by and put it in their cart. And that nice looking produce is also the output, because that's what the consumer is taking home. Let's think about a medical office. What's the input? What's the output? Patients are definitely an input, right? Without patients, medical office won't stay in business. So you could say, okay, the patient's the input. What happens when they get there? What happens at the, okay, some sort of exam or some sort of treatment or diagnosis, right? So that's the processing that occurs. And then what's the output?
Healed person.
Hopefully, yeah. Hopefully the person feels better. Maybe not immediately. Maybe they have to take some meds or something. But hopefully whatever the issue was has been resolved, right? And so that's the output. So we can apply this concept to all kinds of different things. What would be a source document that the medical office might receive? Might they receive invoices for anything? Okay. So if they're going to order some medications to have there in the office, then yeah, their supplier is going to provide them with an invoice.
Would insurance be a source?
So let's think. I would say yes. For example, when you come in and you fill out all this paperwork as the patient, and you provide your insurance, that is all information that is relevant. Some of it is accounting specific, like your insurance information, like your address. That's probably going to go into the accounting system because now you are a customer, right? You're going to have your own account in that medical facilities system. So yeah, the insurance, the documents you fill out, all of that would be source documentation that goes into the accounting system. Okay, good. We're already up to special journals. So any questions about technology, information systems, anything we covered so far? All right. So let's get into this concept. Special journals and subsidiary ledgers. I've kind of been lying to you, or at least not giving you the full truth, because I've been telling you that step 2 is you record things to the journal. Well, there's not just one journal. There are other journals. So some things don't get recorded to the journal, they get recorded to a special journal. And then I told you that step 3 is you transfer what's in the journal over to the ledger. That's not completely accurate either, because there's not just one ledger. There are some subsidiary ledgers that we use for accounts receivable and accounts payable. So that's what we're going to learn about now. And the reason that these special journals and subsidiary ledgers exist is they help organize the data so that it's easier to track. And the main journal is not going to be as, the word I'm looking for, cluttered with information. A lot of the transactions, instead of going into the general journal, will go into these special journals, and it just makes things more neat and tidy. Okay? Same thing with the subsidiary ledger. That allows us to see exactly how much we owe to a particular supplier and how much we're owed by a particular customer. My pleasure. Thank you. Okay? So that's what we're going to learn about now. Overall, I don't think it's super complicated, but you do have to pay attention because it's easy to get them mixed up, and you might want to take some really good notes about this section. Okay, I think you'll find that helpful. So as we see, there are 4 special journals that we're going to learn about. We have the sales journal, purchases journal, cash disbursements, and cash receipts. Now, the cash disbursements and cash receipts are pretty simple because anytime you pay out money, that's a disbursement. Anytime the company credits cash because they've paid out cash, that's going to go in the cash disbursements journal. And anytime the company receives cash, where do you think it's going to go? Cash receipts journal. Nice and simple. Sales journal and purchases journal aren't quite as clear. So let me explain it like this. In the sales journal, we record the sales that were made on credit. Let's think about that. Let's say you've got 2 customers. Customer makes a purchase from you, so you've just made a sale, but they don't pay you at that time. Bless you. Thank you. So, in other words, that sale was made on credit because they're going to pay you later. That goes in the sales journal. But if the other customer paid you cash, where would we record that? Under the cash receipts journal. Okay? So the sales journal is only for those sales where the customer has not paid us yet. You got that? Okay. Yes, there will be an account receivable. Exactly. So for every sales journal entry, there is going to be an account receivable. Then we get to the purchases journal. This is only for purchases of inventory that we have made on credit. So if we purchase an inventory and we haven't paid, we record it in the purchases journal. But if we buy some inventory and we did pay for it, where would we record that? Cash disbursements, because we have paid, we've dispersed cash. Okay, so that is the tricky part here. Just keep that in mind. The sales journal is not for all sales, only the ones made on credit. The purchases journal is not for all purchases, only purchases of inventory made on credit. Okay, any clarification? Yes.
So with the purchases journal, even though it's like an insurance bill. How would you?
Well, because that's not inventory, it wouldn't go there. So you would just record that, so if the insurance company is billing you, that means you've already bought the insurance, you just have to pay for it, right? So in that case, you've already counted the expense. Your cash would get a credit, and the debit would be to, insurance payable. Yep. So any purchases that are not inventory would go into the general journal. Any other questions on these 4 special journals? Okay, so let's talk about the subsidiary ledgers. As Yannette pointed out, if we made a sale and the customer didn't pay, there's going to be an account receivable, right? So that's another area where I haven't been fully transparent with you. So in accounts receivable, we have many subsidiary accounts receivable accounts. We have one for every customer. So we would record it actually in that customer's account receivable. And that's what the accounts receivable subsidiary ledger means. Every customer has their own account in this accounts receivable subsidiary ledger. And that's how we keep track of how much a particular customer owes us. So if they call us up and they say, what's my balance? We would get that out of their account. Okay, so anytime we make a sale to a customer and they don't pay, we would record it in the sales journal, and then we would also transfer that information to their account in the accounts receivable subsidiary ledger. Okay, does that make sense? In the same way, if we purchase some inventory and we haven't paid, guess what? We record that in the accounts payable subsidiary ledger. So we would first post it to the purchases journal, but then we copy that over to the accounts payable subsidiary ledger. And there, we have a separate account for every supplier that we owe money to. So then what we do at the end of the month, we total these up. We look at all of the individual customer accounts to see what's the total amount our customers owe us. And we look at all of the individual accounts payables to see what's the total amount we owe all of our suppliers. We record that in the journal, in the general journal. So this is, basically it's a way of organizing the data to make it much easier to keep track of. Is there anything that needs clarification? All right. Oh, okay, so here's a way to think of it. You know how okay, let me back up. There's a way to think about why we would have a subsidiary ledger, why we would have special journals. It's kind of like your grades. You get a grade on every assignment that you submit, right? Those grades for those assignments come together to make your total course grade, right? Your course grades all come together to make your total GPA. But they're tracked separately. I have no idea what your GPA is. I don't have access to that information. I only see the grades within this course, right? So it's kind of like your subsidiary ledger, right? That I have access to, so I can see your individual grades, but I don't see the total amount because that only other certain departments have access to that. So it's the same idea here. We have the general journal and the special journal. We have the general ledger and the subsidiary ledger. And they all ultimately, they all interrelate. They all feed in to the general ledger. so that you can see at any point in time what is our total in each account. All right, now we'll get into journal entries. So, are there any questions at this point? Okay. Sales journal. If you notice, this looks similar to journal entries we've already seen, but it is a little different. We have a date for each transaction. We see which account, which customer's account here. There's a place for the invoice number, because remember, what we record in the sales journal is only sales that we made where the customer didn't pay. So they have to be invoiced, right? We have to send them an invoice. So here's a place for the invoice number. There's a column for reference information. That column is kind of like up to you as far as how to use it. You might record each customer's customer ID number. That would be a logical thing to put there, right? But it's not an absolute requirement. Now here's where the special journal is very different from the general journal, because in the general journal, we have a debit column and we have a credit column, right? Here, look at this. This amount gets debited to accounts receivable and credited to sales. So we only have to write that amount one time, because we know everything that gets recorded in the special journal is a sale on credit, which means that every transaction in the special journal, in the sales journal, is going to be debited to accounts receivable and it's going to be credited to sales. So instead of having two columns, it's just been combined into one. Makes it simpler. And if we're using the perpetual inventory method, we know that we always have to keep track of our cost of goods sold and merchandise inventory. And we know one gets a debit, one gets a credit. So you see, again, we have to only enter that number one time because we know it's being debited to cost of goods sold, credited to merchandise inventory. So it's a little bit simpler. If we were to post that to the general journal, we use 4 lines. There'd be 2 debits, 2 credits. But here, for that one transaction, it's all in 1 line. Saves us a little time. Okay? But that's about it. It's really not that complicated. We can see there was another customer, made a purchase on credit on February 23rd. See their invoice number, amount of the sale, and the cost of the inventory. All right, any questions on the sales journal? Okay, purchases journal. Also very simple. What do we record in the purchases journal?
Purchase of credit.
Yep, and what purchases? Purchases of inventory. Purchase of inventory on credit, right? Okay, well, we see on February 14th, we purchased from Irving's Inventory. Would that be a customer? That would be a supplier, right? We don't buy from customers, we buy from suppliers. So here, the account is the supplier's account. We might want to put the supplier's account number that we assign to each supplier. We might want to put that in the reference column. But there's an invoice number. Now notice these 2 invoice numbers are not sequential, but these 2 were. Why do you think these 2 invoices are not sequential? Why is one not like one number higher than the other? Yeah, these suppliers are coming up with their own invoice numbers, right? And so Irving's Inventory, they're up to invoice 1,542, whereas Greta's Goods, they're only up to invoice 612. They each have their own system. So we have to go by their invoice number that they assign. Then you see that every purchase that goes in the purchases journal is a purchase of inventory. So we're always debiting inventory, and then we're always crediting accounts payable. In fact, those two columns could be really combined into one, make it even simpler. It's always going to be a debit to merchandise inventory and a credit to accounts payable. Unless, of course, you're using the periodic method, and then it would be a debit to purchases, right? Didn't we cover that last week? Didn't we? Periodic versus perpetual inventory? Yeah, thought so. So not so hard, right? I don't think this is super complicated. All right, then we get to cash disbursements. Now this is a little bit more complicated because there are many reasons we might disperse cash, right? So let's take a look here. On February 7th, Mumford Inc. invoice number, our accounts payable got a debit, apparently. It says or other accounts. So some account got a debit. And then cash got a credit. Okay, so any transaction in the cash disbursements journal is always going to have a credit to cash. The debit depends on what account we're paying for. Now there's a hint. Because there's an invoice number, well, then we were paying a supplier. They provided something to us. They provided us with an invoice. Now we're paying for it. And so in that case, the debit is for accounts payable. But we'll see some other examples where we're not paying a supplier, and so we're debiting some other account. This one also appears to be a supplier because there's an invoice number. And you might be wondering, well, how do we know what account? Right? If it wasn't a supplier, God bless you, maybe we are paying some employees. Well, it would be, based on what account it says here, we would know what account it is that we have to debit. So this is the cash disbursements journal. Oh, I should point out too, I think I forgot to mention it. All of these journals have a page number because there will be other journal entries where we will reference the page number so that if someone needs to go back and see what this transaction was, they know where to find it by the page. Now, if you're doing it electronically, you don't really have pages in the same sense, right? This comes from the old system of using printed books. So if you're doing it on a computer, it might not say page number, it might just have a link that takes you to the original transaction so you can see what it is. Okay, so then we have cash receipts. This is the fourth of our 4 special journals. When do we use cash receipts?
When we get cash.
When we get cash. Thank you, Julian, that's right. And we could get cash for different reasons. Most likely it's from a customer that's paying us, but not necessarily. So here, Connie customer on February 8th. We see an invoice number. Cash is being debited. And then there's a credit to accounts receivable, sales, or other accounts. So again, there could be multiple reasons we would be receiving cash. Why do you think Connie customer is paying us? Would be because we sent her invoice number 450 here. Now she's making the payment, right? That would be the logical assumption. But maybe somebody's paying us for something else. Maybe we returned a product we already paid for and we got a refund from the supplier. That would be a receipt of cash. Maybe we went to the bank and we took out a loan and they gave us some cash. That's a cash receipt, right? So there could be multiple other accounts involved. All right, are there any questions out there? Okay, keep going. So this summarizes it. I'm not going to cover everything here, but the sales journal is always going to have a, let me think. It's always gonna have a credit to, credit to sales, and it's always gonna have a debit to account receivable, right? That's what we saw. The purchases journal is always going to have a credit to accounts payable and a debit to inventory. The cash disbursements journal is always going to have a credit to cash because we're paying out cash and cash is going down. Whereas the cash receipts journal is always going to have a debit to cash because we're always receiving cash. Every transaction that does not fit in one of these 4 special journals goes in the general journal. Okay, which is the one we're used to. Okay, subsidiary ledger. So for accounts receivable, as I mentioned, the whole idea is that customers who owe us money, we record that in their account receivable. Right? Each customer has their own account receivable. So let's take a look here. Customer Smith, their accounts receivable got debited $100 on February 1st. Why do you think that occurred? Why would their accounts receivable be debited?
They bought something on credit.
They bought something from us on credit. Very good. Now, let's look at customer Lee over here. They bought something from us on February 1st. Then there's a credit to their account receivable on February 4th. Why would that be? Why would we credit their account receivable?
Made a payment.
Made a payment or returned the product. Something happened that caused their account receivable to go down from $300 by $200, and it went down to $100. Right? Probably they made a payment. At the end of the period, we could look and see, okay, this customer owes us $400, this one owes us $500, this one owes us $100. The total accounts receivable we have is $1,000. And now we know what's the amount that we can expect to get from our customers. Okay, does that all make sense? All right. Same thing with the accounts payable subsidiary ledger. Here we've got 2 suppliers. ABC Inc. is one of them. We made a purchase on January 1st. So our account payable went up. You know that liabilities get credited when they go up, right? And then we made a payment. So that's a debit to accounts payable, and our new balance is $125. Then we make another purchase on credit. That increases our accounts payable by $50, and we see the new balance. By keeping it separate by supplier, it's really easy for us to see how much we owe to each supplier, right? If we're all in one long accounts payable, how would we sort out which supplier was which? That would be complicated. All right, what is the final balance to XYZ Inc.? How much do we owe them as of January 20th? 30. Yes, $130, right? About $100 worth. We made a $20 payment. We made another $50 purchase, leaving us with a balance of $130. Okay, find the balance in each account. I think okay. This would be a useful exercise for you to work on. It's not from the exercise set, it's just for you to work on. So you can do it, in pairs and in groups. And so what you're going to do is say, okay, here is the accounts payable subsidiary ledger. Here's the first account we're looking at. This is the account number we have assigned to that supplier. Okay, so Elizabeth One Inc. is a supplier, and that is the account number we have assigned. We see our beginning balance at the beginning of the period. That's how much we owe that supplier. We see from the cash disbursements journal on page 124, right? Supposing that's a page number. 2,150. What does cash disbursements tell us again?
You spent cash.
We spent cash, right? So what that's telling us is on the cash disbursements journal, we recorded that we paid 2,150, and obviously it was related to the supplier because it's on their account payable subsidiary ledger. So we're going to, what, add or subtract this? If we have a credit balance and then we debit the account, we subtract, right? Great. And then we make another purchase where we buy something from this supplier. So then we're going to have to add that credit. Then we made another payment. We're going to have to subtract that. So that's how you're going to figure out what's the ending balance in this account. Same thing with F. Nightingale Inc. Same thing with LM Alcott Inc. So with all three of them, figure out what is the final balance. Okay. Then work together and see what you come up with. Okay, let's check our answers here. So what did you all get as the balance for Elizabeth I Inc.? You don't all speak at once. Anybody? All right, let's check. So we started with 3,134, right? Okay, 3,134 minus the payment of 2,150 plus the purchase of 3,112 and then minus the payment of 1,250. Is that what you said? Yep, good job. How many people got that number? Yeah, Donna? Okay, just a couple of people. Okay, good. All right, let's go to F. Nightingale. So they started with a balance of 3,446. Then what do we do? Add, right? They're both purchases. So we add the 2,589. We add the 1,234. Is that what you all got? Okay. Okay, good. And see, it's not that hard, right? The last one. Beginning balance of 3,467. We add the purchases, and then there was a return. Now the return was recorded in the general journal because a return is not a sale made on credit. It's not a purchase made on credit. It's not a cash disbursement, and it's not a cash receipt unless the item had already been paid for. But in this case, it's an account payable, which means we haven't paid for it. So then from the general journal, that return got documented here in the subsidiary ledger. We have to subtract that $250. And if I did that right, I got 8167. That's the number you all got? Yeah. Good. So it's not that hard, right? Anyone have questions? What's next? Oh, okay. You know, I'll stay here for this one. So here we've got 3 accounts and the accounts payable subsidiary ledger. How would we find out the total accounts payable? We have these 3 account payables in our subsidiary ledger. How do we get the total? Add their balances, right? Add the 1,362 plus the 4,468 plus the 8,167. That's easy. Same thing with the accounts receivable subsidiary ledger, right? The only difference here is these are customers that owe money to us. Each one has a balance. If we add up the balance from each of them, We know the total account receivable. Okay. So let's take a look at some examples. Here we have a sales journal. We've got 4 sales. How many customers did we make sales to on credit? 3. Because if you look, you see that actually Baker Company made 2 purchases. With each sale, in this case, there's a column for address. We don't always see that, but we have the customer's address. Here we have their account number. Again, this would be an account number we assign to them in our computer system. We see the terms of each sale, right? That's important because we know whether or not to give them a discount based on those terms and based on the date that they pay. There's the invoice number. There is a reference column. And then we have debit to accounts receivable and credit to sales. So we must be doing periodic inventory because we're not even tracking the cost of the inventory. So pretty simple, right? All you have to do is fill that information in and you've got your journal entry. Now then, if we take Baker's 2 purchases that they made and transfer them down to their account receivable subsidiary ledger, we start with whatever their beginning balance was. In this case, they didn't owe us anything at the beginning of the month. Then they made this first purchase, invoice 45321, and then they made their second purchase. Now see here in the reference, it says SJ26. What do you think that means? SJ26.
Purchase order number?
Sales journal.
Good guess,
page
but no,
26.
it's not their purchase order. No? SJ, what would SJ stand for?
Is it sales journal, page 26?
Sales journal, page 26. So that's where we can cross-reference and see where did this entry in the ledger come from? It came from sales journal, page 26. So we could go back to the sales journal, look on page 26, and we'll find those transactions. Okay? It's a system. And again, we see that, well, let's see. Oh yeah, so we see that they owe us $850. Now we add that to the 0 balance they started with, and that means they owe us a total of $850. But then they make a second purchase, so now we add that, and now they owe us $1,450. Right, so we can keep track of that customer's balance. Okay. All right. With the other customers, obviously their transactions would go to their subsidiary ledger accounts. Okay. Then let's see, here again is the same sales journal. Here's the total, right? The total that we made in sales for that period of time. And that's also the total that's owed to us by our 4 customers. So we can record that in the accounts receivable general ledger. So that is the main accounts receivable account. We know that it's recorded in each customer's accounts receivable subsidiary ledger, but at the end of the month, we could also take this total and put it here. And that way we can match it up and make sure that the totals in the accounts receivable subsidiary ledger match this total in the accounts receivable control ledger. Okay? Are there any questions? All right. So we got those same 4 transactions from the sales journal. We already saw we can bring those to the accounts receivable subsidiary ledger and the control ledger, right? But there's more information there. We can also take that 2,775 and record it under sales. It would go to the sales account so that we keep track of our total sales. Right? So this 2,775 went both to the accounts receivable control ledger and to the sales account. It would be a debit in one, it would be a credit in the other. And if we had kept track of the cost of our inventory, which you know we do with the perpetual method, that would get recorded to cost of goods sold and to inventory. Again, one's a debit, one's a credit. So it's a little more work than we're used to, but it keeps everything really organized and you can check and see exactly what your balance is at any one time. Okay, anything need clarification here? Oh, okay, our first exercise. We're going to journalize these transactions that go in the sales journal. By the way, there are only 8 exercises in this exercise set, which is nice. I think it's the shortest one we've done so far. So I'm going to stop recording here and open up the exercise.